Don't just throw a dart at a board. You need to analyze the market direction first. Trust your analysis. Don't hesitate. Protect your trades. Timing is everything. They also strike a good balance between how much they cost and how much you could potentially earn. Choosing the right strike price is the most important factor for successful options trading. It can make the difference between a profitable trade and a losing one. The market is like a roller coaster. You need to know if it's going up or down before you hop on. If you think it's going down, you might want to buy that put option. But don't just throw a dart at a board. You need to analyze the market direction first. Imagine if you have a coupon to buy a toy for 50 rupees whose actual cost is 200 in the store. The strike price is like that discount price on your coupon. In options trading, the strike price is the set price at which you can buy or sell the index when you decide to use your option. So now let's try and understand the three types of strike prices. First is in the money or ITM. This means the strike price of the option is favorable compared to the current market price. ITM options are like having a coupon that gives you a good discount because the strike price is better than the current market price. They have built-in value because they are already beneficial at today's prices. If you think the market will go up further, ITM options can help you make more money if the market moves in your favor. Even if the market goes against you, ITM options still have some value left, so you won't lose everything. At the money or ATM options. This means the strike price of the option is very close to the current market price of the index. So they react very strongly to price changes if the market moves in your favor or away. They also strike a good balance between how much they cost and how much you could potentially earn, making them a favorite among traders. Imagine them as the perfect middle option, not too risky, not too safe, but just right. Out of the money or OTM options. This means the strike price is not favorable compared to the current market price. They cost less, but you need the market to move a lot in your favor to make money from them. They're good if you expect big changes in the market. However, if the market doesn't move as you hope, these options can end up being worthless. So only spend what you can afford to lose. With OTM, most importantly, watch the time to expiry. Timing is everything. Arrive late to a party and you'll miss the sweet spot for buying your options. It's always wise to decide the strikes of the calls and the puts you want to trade beforehand. If you see a breakout, trust your analysis. Don't hesitate. Don't be the person who does it out of FOMO. Punch is a broker that has a single screen trading app with safety features for part-time traders. If you're new to options trading, download the Punch app and start trading with confidence. See you next time.